There's 10 minutes remaining until the closing bell. Joining us to help break down today's action, we have trader Dan Brady of Entropy Capital, who's standing by live at the NYSE ARCA Options in San Francisco. And our featured guest is Nick Calamos, the co-chief investment officer at Calamos Asset Management. Nick, I want to start with you. Third day down, obviously a lot of concern here about unemployment, but is it the economic data that's dragging on us here recently, or is it the dollar strength lately?
You know, I think it's probably what's happening in Washington right now with the health care plan, and hopefully they can't agree to do anything and go away without, at least go over the next break here without any action. That's part of it. And then clearly the dollar weighs very heavily on investors these days.
What do you think about what's going on in Washington? We were talking with columnist David Riley earlier. He was saying if they don't get health care, they're going to have to go after the banks because they need something to show for the midterm elections. What do you think about that?
Well, you know, going after the banks is a little bit crazy right now. It's probably the most over-regulated industry we have, and more regulation isn't going to fix common sense. So, you know, I don't know if that's the direction to go either. There's way too much government involved right now. The systematic risk out there is Congress, and they need to kind of step back and let capitalism take hold again.
Are you concerned, though, about unemployment? I mean, do you want to see the government step in and do more there, or should we leave it alone?
Well, you know, unemployment, I believe, is going to be very sticky for quite a while, and especially with the direction policies are going right now. The policies are anti-capitalism, anti-entrepreneurship, and penalizing any kind of wealth creation. So the best they can do is try to encourage some risk-taking in this country again, cutting taxes, especially capital gains, and freeing up some capital for people to take some risks again. As you know, the banks aren't lending right now, and they're not going to for quite a while.
You know, I wonder, as an investor and one who's got a lot of experience with Washington, and I guess you don't even need that much with this administration, how seriously do you think that there's a chance of that happening?
Well, right now it doesn't look too good. You know, for 30 years we've said we're long-term bullish and short-term scared, and we've managed money that way. Nowadays we're short-term bullish and long-term scared. The policy directions that we see happening right now are not very encouraging for sustainable long-term growth and a stable currency and a stable, quite frankly, a stable business environment.
Hey, let me bring in Dan Brady to this discussion right now. He's standing by at the NYSE ARCA Options in San Francisco. Dan, you know, we hear a lot of economists, especially coming on here and saying they need to cut taxes and reduce regulation in order to foster more growth in this recovery. It's not really a possibility, though, is it?
Well, I think one of the interesting things with a lot of the policies that they've followed lately is that they've slowed the decline in a lot of these different areas with the Cash for Clunkers program, with the FHA lowered loan requirements, with all these different programs that are actually kind of holding up these markets. They're not actually getting to equilibrium. So what I think is happening in some respects is drawing out the problem. We're not getting to the bottom as quick as we otherwise would be.
What do you think about that, Nick? I mean, we've heard this from a lot of people, especially the big bears out there.
No, you know, that's absolutely correct. You need to see money move back into the strong financial hands from the weak through mergers, acquisitions, bankruptcies, what have you.
Failures, right?
Right. The market's got to clear. And propping up the businesses. Look, they propped up Fannie and Freddie and GM and Chrysler. None of them are working. It's not going to work out when the government gets involved there. You need to let economic forces take hold. And I'm not talking about stepping away and let everything collapse, but I am talking about setting up policies that create wealth and capital in this country.
Let me get back to Dan Brady right now, Entropy Capital, standing by at the NYSE ARCA Options. Dan, let me ask you, talking with you and Nick about what you guys would like to see out of Washington, we never really get to what you expect to really see. I mean, what's going to happen?
Well, I think that they're going to. They've been talking about how the purchase of the mortgage-backed securities is scheduled to end up in the first quarter, and I think that they're not going to be at a point in the economy and the recovery where they can actually do that. So I think they're going to continue to prolong that. And if you just look at the implied short rates, they're expecting basically a zero interest rate policy for another year. So the question is not so much what the federal government is going to actually do, what the Fed is going to do, but whether the rest of the market's going to do in response to these very, very lax monetary policies.
Well, but also, I mean, you're talking about what the Fed's going to do. You're looking at more stimulus, more quantitative easing, or you think at least an extension thereof, and cheaper money. Do we see, though, this health care bill go through? Do we see higher income taxes on the rich? Do we see more regulation, the kind of things that especially supply-side economists are concerned about?
Well, if I could bring it down to the state level, here in California, we have like a $21 billion budget gap this year. And they don't have quite the luxury that the government has in being able to fund that. So what we're going to see here is increases in taxes. We're going to see a lot of layoffs within the state government. And that, as it goes on over the next 6 months or a year, is going to have a further knock-on effect in terms of growth. We're going to see the government payrolls decline, and you're going to see less economic activity because of that.
Hey, Nick, let me bring you back in here. I mean, how do you invest to deal with these factors? I'm sure you expect some of the same things that Dan is talking about here, increased taxes, even though you don't want to see them, more regulation, even though you'd like to see less. How do you invest to deal with that?
Well, I think you have to look for the opportunities and what kind of companies can deal with a chaotic environment and a deflationary environment, because globally everybody's going to try to export their way to prosperity. The technology sector is used to dealing with deflation. They're used to dealing with pricing pressures. So there's tech companies out there with great balance sheets that have great management teams in place that are used to dealing with a very difficult environment, and they're also productivity enhancers to boot. So the technology sector will be the new leadership, I believe, for the next decade.
Let's get back to our featured guest, Nick Calamos, Co-Chief Investment Officer at Calamos Asset Management. Nick, let me ask you what you think, you know, since we're talking about Bill Gross a little bit here, about the new normal. I mean, do you expect, if we really do see increased regulation, as you hope we don't, but increased regulation, higher taxes, less participation for the U.S. in the global economy, a new normal here with slower growth going forward?
You know, I definitely think even without that, we're going to have a new normal. People have been shocked here. Businesses have been shocked by the extent of the fall off. Global trade rolled off the end of a table. So you're going to run your business more conservatively going forward, and your balance sheet at home more conservatively. That means more savings and most likely less new job creation, even if we don't raise taxes.
What about the equities culture? I mean, do you see people being more reluctant to get back in the water here? I mean, baby boomers have gotten burned a couple of times already. Do you think that that there will be a shift, really, in how people balance their asset holdings?
Well, you know, that seems to be going on right now. There's been a big move into bond funds over the last year. And once the equity funds perform well for an extended period, people will be back in. Hopefully it's not at the top. But if you're not going to provide enough wealth creation in bonds, especially with the amount of money that's been printed out there, at some point it's inflationary. You need a real return on your money. So ultimately you need to have some equity exposure.
Let me ask about Nouriel Roubini's comments that equities are chasing commodities. What do you think? I mean, commodities prices still obviously a long way off from the highs that we saw last year.
Yeah, I mean, all the industrial commodities have a long way to go if you know, the old peak is the goal there. You know, he's looking for the next big imbalance out there, because the world monetary regime has changed, or is trying to change, away from China providing cheap goods to us and also cheap capital. And in return, we provide jobs to them. And that seems to be changing. So right now, it's easy to chase the commodities. They're early cyclicals, and you have a weak dollar. And the only strength out there in the world tends to be coming from the emerging economies, which are commodity-driven economies. And as you know, China's trying to spend all the dollars they have here, and they're buying commodities and building their infrastructure. So it's an enticing trade, no doubt.
All right. Hey, Nick, appreciate you spending some time with us today. Nick Calamos there from Calamos Asset Management.
Thank you.